So here I am. I go into Macy's and I buy a big piece of luggage and a carry-on, and I'm walking through the mall with a watch and
the luggage
and rolling the luggage out to my car. Like things, times have changed. It just was a weird experience because I don't usually do that kind of stuff. Hello and welcome to the Retireable Podcast. I'm Mike Wallace.
My name is John Sauger.
Well, hello, John. How are you doing today?
I'm good, Mike. I'm good. Another day recording, another episode we can get on here and talk about some good stuff. So.
No, it is kind of crazy though. I know you've been lately, and obviously in both of our positions, it's a good position to be in. But it just seemed one of those harrowing mornings, to get here and get it all organized on time. So yeah,
it does. It's funny because even when you listen to any other podcast, you'll hear people talk about that, and you experience it kind of organizing. Okay, what are all the other things that go on around that? To get to that point, and some of the different conversations you have in preparation for what you want to talk about. That's always fun.
Well, it is funny, and it just a lot of the stuff what we're doing, and of course, you and I both have adult children still. Well, almost adult children, or they're adult children, but you know what I mean. But my youngest is still in at Purdue, as we talked about earlier, and so I just wanted to share something with you, John. Just happened to me last night. I'm going to ask you this question: when's the last time you've been inside of a mall?
Oh, goodness. I know it's a terrible answer because you're looking for a longer term, but it was last week. We actually had to pick something up from a store in the mall, which was really.
Did you go to Somerset, or where did you go?
Great Lakes Crossing.
Great Lakes Crossing. Okay, so yeah. So I mean, again, we go to the mall, periodically, but not nearly what we used to do. Of course, with Amazon and everything else.
Sure.
And so, and even the malls that I've gone to, I used to live out on the east side of the Detroit area, and we'd go to Partridge Creek, which is more like an outdoor mall, which is kind of one of the newer and up and coming things with a lot of these places are more outdoor malls. So I'll kind of shorten up the story here, but my son David is a senior, as you know, at Purdue, and he's a competitive gymnast, and so it's his last home meet. So this weekend is senior night. Okay. So again, after he's got a couple more meets that are not home meets, but like he's going to be done as an athlete for the rest of his life. So it's kind of a big deal. So we're trying to wonder what, they're going to honor them. And so like last minute, we just, we need to get this kid something. What do we need to get him,
Sure.
And so we were kind of thinking about what we should get him. And I know he broke his watch recently, and he was asking for a new watch. So we're like, okay, let's get him a watch. And then I remembered about Shinola. Okay.
Yep.
And so we were like, let's get him a Shinola watch. So I was looking on the internet, and I was just going to go down to the Detroit store because that's the only one I actually knew.
Right.
And there happened to be a Shinola at the mall, which is real close to us now. It's Somerset Mall, which is in Michigan. If you're not familiar with it, is the premier mall, the high end mall. And so I go into the mall, and again, I've been in there a few times, and usually just one store here and there, but I go in there and I look at the map, and of course I parked on the wrong side of the road. This mall goes across a big thoroughfare, so I had to walk all the way over
the bridge,
over the bridge, and everything else. And so then I'm by myself, so I'm just walking around, and again, I feel old syndrome. I'm looking at all these stores. I have no idea what any of these stores are, and wondering what the heck they're even selling half the time. And so I go in there, and of course it's Shinola, a beautiful store. Got him the watch, got amazing help and everything else. And so then I'm walking back, and I had some time to kill because I was going to meet my wife after she had a band concert at her school last night. So I was going to meet her, and so I'm just walking around, and then of course you're people watching, right?
Yes.
So you're just like kind of I just getting my steps in and walking around. I'm seeing the mall walkers, of course.
Yep.
Of course, a lot of the kids running around, and it was amazingly busy, as well at that time of day. And then I'm walking around on the top floor, and I'm going by Macy's, and they happen to have their 50% off luggage sale.
Nice.
So again, the same kid lost in one of his moves, lost a piece of luggage. So like just the carry-on. And then we had got one damaged, a bigger one. So here I am. I go into Macy's and I buy a big piece of luggage and a carry-on. And I'm walking through the mall with a watch and,
And the luggage.
and rolling the luggage out to my car. Like things, times have changed. It just was a weird experience because I don't usually do that kind of stuff.
What's even more weird is I literally have to pick up luggage from the mall by me. I have to pick up luggage on the way home today because my luggage broke on my last trip. The wheel got busted up, and now it won't. So I have to pick up, and I was literally in a mall the other day, and the mall by me, the Great Lakes Crossing Mall, they have a Shinola. They have a.
Oh, they have a Shinola too.
Funny, yeah,
I did not know that the Great Lakes has
a smaller.
Okay.
But yeah, there's one there.
Yeah, because I'm like probably like almost in between the two. Yeah, that's where I live.
The funny thing though, like you said though, is the multi-usage of a mall, trying to figure that stuff out, right? Like one of the things about Great Lakes Crossing is it's built in kind of a circular pattern, so you'll see a lot of mall walkers walking around and doing that,
and they literally have it marked off like how like
your distance, what zone you're in, etc. But it's so interesting because that's a good mall example of how they've made multi-use. Like each zone has some sort of multi-use thing to draw you in. The one zone has a Lego store, so you can get kids to go play with Legos and they have a little bit of a Lego experience. One of the zones has I believe it's an aquarium. One of them has one of them has the movie theater. But it's interesting how that type of thing that we're in our 50s, we grew up going to malls and doing that, in that experience of that's where you went to get stuff. Now you can go so many different places, whether it's online or whatever. But yeah, it is interesting. We literally had that conversation this morning. My wife had said it to me. She's like, you have to go get the luggage. You won't have time to get it here before we leave in a couple days. You ran out of time to order it. You got to go pick it up. So yeah, it's kind of funny how. Well,
and it's interesting too. We used to go to the department store, to get certain branding, and now each brand has their own store.
Sure.
Again, when I was a kid, and I didn't even know that they still had them. The Canada Goose jackets, right? Okay. They have a Canada Goose jacket store.
Okay.
The mall. I didn't know they had that before. Mm-hmm. And of course, the stuff we were familiar with, the old style stores that that was in 20 years ago are all there. But again, there's so many new brands that I have no idea even what they sell. Even when you're walking by there, I'm like, what is this kind of thing?
Yeah.
But also even the locations. So again, I haven't been in that mall for a hot minute. And some of the stores that used to be on the south side of the street, I guess the north side must be the more premier, get more traffic. So some of those stores have now transferred over to the other side of the mall and had better locations and
that's fun.
And things like that. So anyways, I just thought that was kind of interesting, and I wanted to share that with you as our little banter. And it probably went too long, but it is interesting how things have changed. And again, when we have these stories, I feel like it's the old man syndrome, right? When I was a kid.
Well, no, but it's funny because you can travel around the country and you can see how malls are changing, and people are. That's one of the things trying to figure out. How are you creating multi-use stuff? How are you getting foot traffic in there? That is absolutely a component of society.
And how many malls just died, right? There's many malls that we used to go to as kids that are not even there anymore.
No longer there. Yeah, absolutely.
Or some of the department stores that are going out of business again.
Right.
So when it comes down to that,
right.
All right, so let's get into our subject today. So, as a financial advisors, we get lots of different training in different areas and so forth, and so this happened to be just more of a timely subject because John, why don't you tell us a little bit about what you did and where you went recently to learn about some of this stuff?
So I was just at more of a. I mean, we go to all these different conferences. We talk about it almost every time we're recording.
We're always learning something. Yeah,
something
exactly.
because there's constantly different things you want to learn. And again, everybody looks at things differently, so you want to hear the different components. But I was at a high net worth forum, and so that was more of a conversation on what are things that are uniquely designed to people of a certain dollar amount, whether it's they have a certain amount of money in retirement assets, whether they have certain highly appreciated assets, whether they owned or were selling a business or whatnot. That there's a different mindset or mindset's probably not the right word. There's a different set of circumstances that you have to know in that environment, and that is something that's different than a person that worked a job and retired with a 401k. They're a little bit different in that.
Well, I mean, there's really been an evolution in our industry and an evolution in just the net worth of the middle class millionaires as well.
Sure,
So when I got into business in 1991, most of the people that we worked with had pensions. And so they, a lot of them, or they're saving money in the bank because the CD rates were, whatever, some of them double digits back in the 80s, right?
Well, you think about it, 401ks had only been around, a little over 10, 12 years at that point, right?
Yeah,
They only came
exactly.
around in 78. So, I mean, yeah, it only been 13 years.
Yeah,
So,
and
yeah,
and they weren't being utilized as much because they still had their pension, so that people
correct,
didn't, save a lot of
correct.
that money. So when we run into, I wouldn't want to call them high net worth people, but people that were, a little bit more, wealthy at that time, maybe $500,000
Sure.
was something, if you see a millionaire, that was like someone that was like,
There's a shock.
yeah, yeah,
Yeah,
you didn't see that
there's a
many,
shock.
many, especially in the Detroit area here, in the with a lot of the auto workers and so forth. But what's now happening, and part of it's the evolution, part of it's the market. We're now running into, what commonplace are the middle class millionaires.
Right, right.
Okay, and so when you're dealing with the middle class millionaires, a lot of them, 1 to 3 million, 1 to 5 million, or they had a million or two, but again, some of it has
Right.
increased because they're now in their 70s or in their early 80s, and that $1 million has grown to 3, 4, $5 million, that we're running into once in a while.
Well, and you've gotten to two different. There are different categories now, right? You have your affluent or your mass affluent person, which is, hey, they have X number of dollars and below, right? I mean that's a lot of society. When by the time they can retire, they have $750,000 to $1 million, right? Your high net worth is like, hey, we have 2 million and we have really good income, or 3 million and we need it for income, right? There's a delineation there, but then you get above, let's say 10 million, you get above 15 million. Now you get these other terms, like there's a term now called ultra high net worth, right?
Yeah.
Or ultra super mega high net worth is like, over 100 million. I mean, you get that's not the real name, but you know what I'm saying?
Yeah, no.
But no, you get that. And that's realistic in today's society right now. I was just talking with a family the other day, and the son he's 27 years old, and he opened up a couple of companies growing. He got the license to grow medical marijuana. And all of a sudden the net worth went millions and millions. And now we're well into the double digit millions. And he's looking around going, what do I even do right now?
Yeah.
So it's very common nowadays that you're going to see that.
Yeah, no, it is amazing, and so where we were oftentimes, running into, just the millionaires, not very often, 10, 15 years ago, it's now commonplace, and now there's multimillionaires, and so we're going to have this discussion a little bit more about, I'll say high net worth. So what would be your definition, let's say, of what we're going to be talking about today when we say high net worth? And I know it's a range,
Well,
but yeah,
maybe we look at it differently than a range, because different. It's kind of independent. The way I heard it in this forum was actually really good. It was people moved from a need. They need their money to provide income or for enjoyment or whatever they're using it for in their lives. They move from a need to a want, and meaning I'm not running out of money in my lifetime. So now anything I have is a want. I don't have to worry. I don't need to say, oh my gosh, I have to make this decision or this decision. So you've moved from a need to a want. Statistically, it's that $2 to $3 million range and above. $2 million if you have income coming in
okay,
that fits your needs. It's $3 million if you don't have income and you have to use your money to do income. So,
okay.
but it's more it's more mentally, you've switched from a need to a want, if that makes sense.
Yeah. So what I'm hearing you say is, if you're in a position where, the odds are, okay, that you're never going to run out of money,
Sure.
because your income is sufficient, or you have enough assets to generate the income that you would need. Um, and again, we can never say never, because there's many different things that can happen, but the odds are, you're going to be pretty successful as far as being able to meet your needs for the rest of your lives.
Right.
Okay.
Right. That'd be the goal
Yeah,
in that example.
and then the other hard part about that example too, when we're dealing with, some of these high net worth individuals, is, where is their money? Is it in, tax free accounts? Is it in after tax accounts? Most of the people we see have this tax ticking time bomb of their pre tax money, right? Because
Yeah.
they've been really good at saving in their 401ks or 403bs or 457s, or then there's after tax money. And if this after tax money, is it really, is it being invested properly for tax
Is it
efficiency?
functional? Right.
Yeah.
Well,
Okay.
and what's really interesting, because the last thing you said there, I think, is really the difference mentally. Investment management, investment planning is very, very important. We've talked about that many, many different times, but in this type of space, it's not the most important.
Yeah.
It's the tax management, it's the utilization of that is the most important thing, because you figure most of people that have gotten to that level, If they've gotten to a level of that high net worth because of being an investor, they've probably either they've hired someone that's doing phenomenal and they're not worried about it, or they've been doing it themselves. And so they don't need investment management at that point, right?
Yeah.
Most of the other people that have gotten there, whether it's a highly appreciated assets, whether it's a business owner, whatever the case may be, they don't necessarily need as much investment management, right? They need to have good returns. Don't get me wrong. It's important. But if the market does 25 and they did 20, they're not going to, it's not going to change their life in that example that. So it is more the tax management, tax mitigation strategies, the overall keeping of money in that regard. And there are many, many different things designed to allow you to do that. But that's really where the focus needs to lie in that conversation.
Well, and that's exactly why a lot of people hire us in the beginning for that reason, because it gets a little bit more complicated at that point, because a lot of people we run into are great savers, okay, and they may even be good investors, but the other pieces can be missing,
Correct.
So we want to make sure that, and when you're dealing with people that have $3, $4, $5 million, the differences now are not tens of thousands of dollars; it's hundreds of thousands of dollars, if not millions of dollars. I like what you said though earlier, John, about the difference between the wanting and the needing, because at some point, a lot of these people that we deal with, and again, one of the reasons I love my job is because we see people every day that retire and reach their dreams and goals, and that they get to their spot where they're able to maintain their standard of living and have a good lifestyle. But oftentimes now it's where the decisions have to be made, and it's more evolving the more money you have.
Correct.
And what happens is we see all the time that a lot of the families that we work with and that decide to work with us, that were making good decisions 10, 15 years ago, and they were great decisions back then, but then they didn't change. And so
For sure.
So then it's now where it becomes kind of an issue sometimes, because you have to unwind some of the decisions that they may have made, and sometimes it's a several year process. And it's not that it's a bad thing; it's just that it's maybe too concentrated in a certain industry or in a certain type of investment.
Well, the other component is that as laws change, it's very interesting, because right now we're under a Republican administration federally. So you look at that and go, okay, historically, and I'm not creating new ideas here. I'm not telling anything that people haven't heard before, but historically, one of the things Republicans will focus on is lower taxes, lower government spending, et cetera. So if you look back and go, okay, well, this is when taxes were lower over this situation or this situation, you also see there's a point where something has changed in the rules. For example, you might say, well, taxes were lower when Reagan was in office, but okay, what did that do to we now have to tax our Social Security, right? That we didn't do before. Or taxes were lower when George Bush was in office, but did that create the IRMAA calculation on Medicare? Or what did those comparison things do? And so when you look at it, there's constant law changes, right? And so when I was at this forum, that's one of there was a lobbyist that was there that was talking about, these are the things that the government is talking about that are going to impact us. And I think that's really important when we talk about this subject matter, is that on the financial world, especially, a lot of people will kind of lull themselves to sleep because they're putting money into their accounts. So they think they're, hey, I can invest well and do stuff. I'm not even going to get into that conversation. When you get to a spot where we have the money you want, again, where we're looking at there, we put together our plans to make sure you're not running out of money. Vital step number one. But when we start talking about tax management, regardless of what assets you're at, but certainly the more zeros are behind a person's name, right? The more assets are there, the more knowing the tax rules and knowing the tax ideas, knowing the tax implications is vitally important. And knowing that they're changing every administration, every year, it's constantly evolving. And just this year, because you've been at some of the stuff that I've been at, use myself example. I did the calculation. I already have well over 50 hours of time in front of people learning the updated tax code and what the expectations are going forward and what that means. And so if you calculate that back out, an average semester at college is 48 hours worth of time in a 16 credit hour, 16 week semester. So, it's something, if you want to do this yourself, you can really dive into it. We can tell you where to go, but most people want to employ us to get this information and this knowledge.
Well, and the key to a lot of that stuff is education and information. We do a lot of workshops, and all across the country, on web based and obviously in person, et cetera. And so what's happening now is with the law changes. I mean, just think about how many times even the estate tax laws changed in our
For
careers.
sure. For
It's been
sure.
pretty stable for the last 8 years or 10 years, but bottom line
It
is it
was
was
2010, it was gone,
yeah,
right?
yeah.
And that's the famous story of George Steinbrenner, who owned the Yankees, died in 2010,
Yeah,
and his family, how much money it saved his family
when they had
because of that,
unlimited
right?
tax
Right?
exemption for estate planning. So,
Yeah,
so a lot of it is then, understanding. And when we're, the education is the key. And
right.
so, and obviously, if you can get that information and shortcut your learning by working with a professional, it
Sure.
oftentimes can save you and help you
What
dramatically.
and so the conversation on this today is we're going to give some examples of stuff.
Mhm.
It's if obviously examples are never meant to be, something that you should take and do immediately. You got to figure out what's in the best in your situation.
Yeah,
But
this
I
may
think
not be right for you in
right.
particular, so that we have
But
to
I
always do our disclosures.
but I think this conversation more than anything is people are going to go, huh, that's a good idea, and you're going to want to try and implement it. We're not giving you the full thing here. We're going to explain something basically, but you're going to need to ask more questions. It's not
Yeah.
as, hey, they said this, go to my person and do that. That's hard to.
It's individual planning,
Correct.
when it comes down to that. So that's a good point. So let's talk about a couple of different examples, and then we can do some of the simple stuff first that people can even do without being high net worth, and then we'll kind of ramp up a little bit more, because a lot of that simple stuff that the high net worth people are not doing or should be doing. Again, more zeros, the bigger the impact.
If you break it down, I can break it down into 5 things,
Okay.
and I'll say them quickly, and we can go back into them. But it's no matter where you're at, right? It's where are you at on Roth conversions, and again, the most simplistic component of Roth conversions, we can dive into this. We've had episodes completely on this, and
I mean, we'll have future episodes on that.
absolutely the most simplistic thing
Yeah.
is you have a partner with your money. Would you rather buy that partner out at a lower rate when you don't have as much money there, or 30 years from now, 20 years from now, when the accounts are more value and you owe them more money, right? So you got Roth conversions, you got life insurance, because it's a tax-free component. You have, qualified charitable distributions, or QCDs. You have donor advised funds. You have tax loss harvesting or de-risking a portfolio, right? So you have 5 things that you can do immediately, and there's spin-offs of all of those.
Mhm.
But that's the same no matter what dollar amount you're at. It's just, how does it impact your life? But those things can be done in any situation. Now, how do you do it for each person? This is where it becomes we can't tell you exactly what to do. We can kind of tell you how it works, but how
Well,
to us they layer together.
yeah, and more importantly, it impacts, especially the high income earners,
Mhm.
let alone the high net worth individuals, more when you're doing some of these things, because there's certain things we have to consider. So let's talk about Roth conversions, for example. Roth conversions, as simply put, is you can take money from an IRA, and then convert it, pay the taxes on it, and can grow tax free for the rest
Sure.
of your life. Okay,
Sure.
but you got to pay taxes on it in that tax year.
Well,
Okay.
but the key on there is, okay, so that conversation makes sense. Absolutely.
Mhm.
The planning part comes in what you're doing versus how you do it. What you're doing is, you don't need to take a required minimum distribution on a Roth IRA.
For the rest of your
You
life.
don't need to pay federal taxes on it. You don't need to pay state taxes on it. It doesn't kick you into a higher bracket when you take that money out. So like the IRMAA calculation on Medicare, which means you're going to pay a little bit more on your premium. So all of those reasons, it's like, well, this makes a lot of sense.
Yeah.
But what's the right time, the right dollar amount, the right thing? And that's where where the actual planning comes in.
Well, you actually said something very important, and I want to discuss, because a lot of people don't understand, or maybe not, especially in the high net worth individuals, because we've seen some of these people retire and like, holy crap, what happened? Let's talk about IRMAA. So, why don't you explain, John, what IRMAA does and what it means for for the impact of people that are earning. Now, these are for retirees over age 65. Okay, but why don't we talk a little bit about that?
It's essentially, and I was actually I wanted to get the exact wording, but IRMAA is IRMAA. So it's essentially what IRMAA is you've made, you've reached a certain income level, and you've hit a platform. And so when you have high income, what Medicare is Medicare takes money out of your Social Security, or you pay for it out of pocket. If you're not drawing Social Security, you pay for your premiums for your Medicare. IRMAA is a surcharge if you've made too much money, and there's different levels of it, but quote unquote too much money. So the idea is trying to equalize things for people that are high income earners. Their healthcare should be a percentage of expense compared to someone that's a low income earner, if that makes sense. So, hey, if I'm at a low income and IRMAA is, 1%, I'm just using it as a round number. I know it's not exactly, but 1% of my income, then if I'm a higher income earner, it should be, that same 1% is more money, right? So it should be somewhere. So the idea was the government was trying to make sure everybody was paying their fair share. What's happened now, though, is with Roth conversions, any income counts towards it, and you might fall into that calculation and realize you have to pay a higher rate. What IRMAA is going to look at, or what Social Security, what your tax situation will look at, they're going to look at the previous 2 years of income. Mm-hmm. So if you have a really high income before you kick onto Medicare, because you did a Roth conversion at age 64 and you converted $300,000 to a Roth IRA, you have to know, did that make perfect sense to do it? And maybe it did, maybe it didn't. You have to do the math, but you also have to know that might put you into a higher income limit for the next couple of years for your IRMAA calculation. So you might be paying a premium for a short period of time. Again, it's a fluctuating number that is going to be kind of a penalty for using your own money and doing planning. In that scenario, you have to do the math. Does that penalty make sense or not? And that's something we'll go into further when we talk about people. I know people listening to it now, if you haven't heard of it, you're going, what does this even mean? It means you have to talk to somebody planning when you're doing these calculations.
Simply put, if your income is too high, once you reach age 65, then they can increase your Medicare premiums, which basically decreases your Social Security.
Technically, it's 63 because they look 2 years in advance.
Yeah, I'm sorry, but you're not giving the premiums. Yeah, exactly right. But they can look. Yeah, but they go the 2 year look back too, correct. and then there's a 2 year impact on it too afterwards. And so I guess let's look at the two people that we see that it impacts the most. Number one, we see people that are high net worth or high income earners and that retire. Let's say after age 63, right? So their income is really high, and then they retire, and then all of a sudden they have 2 years of penalties when they draw their Social Security, and it's a little bit higher. We also see the impact sometimes when we're dealing with the Roth conversions themselves too. Okay. And I guess there's three things. Last things we see people with high net worth or high IRAs, and they have to start taking their distributions at 72, 73. Sure. We saw it at 70 and a half back in the day too. And then it kicks them up to that next level as well. Okay. Sure. So it just becomes important. So it doesn't mean that you shouldn't do it. I mean, we do with Roth conversions and we'll go past the brackets and it makes sense oftentimes because, to pay an extra, let's say, $70 a month for the next, 2 years versus having hundreds of thousands of dollars tax-free for the rest of your life. Correct. Sometimes it makes sense. Okay.
Well, and if you think about it, in certain circumstances, especially here, we're talking about high net worth. Yeah. You might have a required minimum distribution. If you don't do any planning, you might have a required minimum distribution. The required amount you have to take out for the rest of your life might be well over $100,000. Well, now you've kicked into IRMAA anyway. So you might as well kick into it for a couple of years doing a conversion versus being in it for a 20-year period over your lifetime, right? I mean, it is something you have to look at. It's one of those little nuances with the tax code that if you don't know the rules, it's gonna be very frustrating to you, and that's why you talk to somebody that's paying attention to that constantly.
Well, and more importantly, we see people oftentimes make just 1 year mistakes.
Correct.
Okay, and so they didn't know. They might have took $100,000 out of an IRA because they had a landscaping project, and then all of a sudden now it impacts their IRMAA for 2 years. So it's just understanding the rules. The great thing about it is two things. Number one, it is math. Okay, we talk about it many times. Yep. It's math. We can figure out the math, and if the math works, it's not my opinion anymore. It's the numbers. And number two, there's software and technology that can kind of show those things. Exactly. And it's again, we used to have to do those calculations ourselves by pencil and paper not too long ago, and now we can put that in the computer and know within seconds, if not minutes.
Well, and what you're trying to do there is, again, you're trying to layer things. You might look like you just said, well, I'm going to go into this calculation, but I'm going to go into this penalty, but it makes sense because of these three other things that benefited me, right? So it's okay. So we talked about Roth conversions. The other conversation, I mean, there's so many other different things. Let's talk just briefly. We talked about this in other episodes, but how this layers in. I think it's one of the most underutilized concepts. Whenever we talk about it at workshops or whatnot, I'll see people writing it down furiously like they hadn't heard about it before. So a QCD, qualified charitable distribution, and how that works for somebody that's a higher net worth or that's doing that, right? So
a qualified charitable deduction, you have to be of required minimum distribution age, okay, to take the distribution. But that money, and I guess if you're, what is the age limit if you're,
It's 70 and a half right
yeah,
now, like
70
you
and a half
said.
right now. So basically, if you're not taking distributions right now, I just want to clear that up with you because that's what I thought too, is that, okay, so even if you're 71, for example, and you're not supposed to take distributions till 73, you can actually take money out of your retirement account and give it directly to a charity and not pay taxes on it.
Well, and the brilliant thing in that, if you think about it, is it's the most simplistic viewpoint. I had a workshop, a luncheon yesterday, and it was a group of people, and I was talking about it, and a gentleman there raised his hand, and he said, I was explaining this concept, and he said, well, what if I don't give to charity? And I kind of drew a little chart, and I said, well, this is you. This is how much is going to the government. This is how much is going to you. If we can give this amount to charity, there's less going to the government. He goes, stop right there. I'm charitably inclined now.
Yeah.
And I was like, okay.
No.
So it is a component where we should have that conversation with everybody, especially in our high net worth or our larger dollar amounts. It's really important.
It is so funny that you say that, because there's many times I'm explaining to individuals and I ask that question, and it's kind of evolved, because I used to ask the question and then I didn't bridge it, but I'm like, okay, I ask the question, are you charitably inclined? And sometimes they say, well, not really, or no. And then after the exact same thing happens. After you start explaining how these things work, I have many clients that were not charitably inclined that are very charitably inclined now, because the tax impact for themselves and for their family in the future is so huge. Okay.
Well, and I actually was talking with this gentleman a little bit later, and he asked me, he said, John, what if I don't know what charity to give to? And I said, well, I got a ton of them. I got ideas. There are actually, just so you're aware, there are actually websites you can go to research charities and find stuff. So we talked about that. I said, when he comes in for a visit, that'll be one of the things we'll do. We'll sit down and we'll go through. And he's like, yeah, I'm going to need some help talking about that. I said, well, great. I said, I can give you what I like, but that's my opinion. That's not, fact. I said, if we're talking facts, we can research stuff and we can talk about it, and you can get comfortable with where you want it to go. So.
Well, and let's go one step further with that. And again, I know we've had a episode, strictly talking about this. So we'll touch on two other real quickly. The donor advised funds.
Sure.
Okay. So a donor advised funds is where people can just get a tax write-off. So they may be charitably inclined or should be charitably inclined. So they want to, or need a bigger write-off in 1 year.
Yep.
So because of the Tax Cuts and Jobs Act of 2017, the standard deduction is so high. A lot of people, if you're not giving more than $30,000 a year or 20 some odd thousand, you cannot deduct anything. So, but what you could do is, if you do now in one tax year, put 10, 20, 30, $40,000, into a donor advised fund, if you have other deductions, obviously.
Sure.
Otherwise you have to be more than 30, right? But then you can dole it out over several years, or even, I'm sorry, go ahead, John.
Well, no. And I was just going to say, that is so useful in so many different assets, or so many different aspects, but it is a very useful tool, a highly appreciated asset. And you're going to kick into a spot in 1 year where you're selling this and you're going to pay a lot in taxes. Well, I can, it's a capital gain tax. If I can get into a lower tax rate, if I can save money, I can use a donor. Hey, I give $10,000 a year to my charity. We'll dump $50,000 in there. That's $50,000 of passive savings, right? We can adjust on that, and very, very important.
Well, and even with the higher net worth individuals, some of them have their own funds. They're their own foundations or own funds.
100%.
And so, we have individuals we've dealt with over the years that have done that, and basically, and you're exactly right, highly appreciable assets. They might have bought some stock or an index fund, 30 years ago.
They're selling their company, or they're sitting on gold, or they're sitting on, for sure.
Yep. And so what happens then is, they may, I have someone to deal with right now that he's very charitably inclined, and just scholarship funds, probably $25,000 to $50,000 a year he will actually put in there. But every few years, we take $100,000 or so of his highly appreciable assets, we put it into his individual. He's got an individualized one.
Yeah.
But yeah, that kind of stuff, I think, is for high net worth individuals is a good tax impact, especially if you have many times those individuals, like a business owner, for example, has, a 1 year where they have to offset
Right.
taxes.
Right.
And so whatever they can do,
Well,
and that's a huge thing that they can do.
in retirement versus working, like there's a different component there, right? We talk about this podcast is retireable, right? In retirement, you don't have the business expenses, right? You can't say, oh, I need to buy a new car and I can offset that as a business expense this year, or I can offset some, you don't have that as much in retirement. So it's like, okay, I've gotten rid of the business. I need some of these components. So yeah. Good, great tool. A lot more to it than what we just said, but just to be aware, it's a very, very useful tool that we can add in when we're talking about this
I
space.
think that's fantastic. And then I think the last subject we're going to talk about is more about estate planning. But before I get into that, John, I just want to, is there something else that that's more investment side of things? I know there's a couple more tax things I can think of off the top of my head too. But is there, before we get into the estate planning subject,
you're essentially when you're talking about in the investment world, you have different types of investments. There are a ton of different components. There are actual investments, like a charitable remainder annuity is actually an investment that you could say, hey, I would like an income stream from, and the remainder goes to charity. I mean, so there are investments that you can use. There are also
donor advised fund is an investment per se.
You can do that. The other part though that is it's very interesting on the investment side. It's not so much the generating income, but you might be doing some what we call tax loss harvesting. So that's a very good example of the investment world, where you're going to say, hey, I'm going to mitigate some gains with some losses. And so you might say, hey, I the market's up 10% at the end of the year, and I owe taxes on that 10% gain. Well, tax loss harvesting would be when the market fluctuates and goes up and down. We're repositioning and using some changes in your portfolio to get you to also have some losses. And so you might say, hey, I have a real 10% gain, but I had some temporary losses. We can add those two together so you're not paying taxes on that full gain. Very, very different when you're talking about this statistically, doing the research and finding this. I'm not going to give exact numbers, but doing the research, a lot of people have heard of this conversation. A lot of people have heard of this. When you look at portfolios, though, it doesn't feel like people are doing it. It just feels like they're not doing daily loss harvesting or doing weekly loss harvesting. It feels like they might look at it quarterly, or they might look at it, in unique events or whatnot. But this should be something that's done on an ongoing basis.
Well, and I think, and we talked about this before too, but one of the biggest things that we see oftentimes, a lot of the, especially some of our clients that are getting older too, is the old way of investing was the buy and hold strategies.
Mm-hmm.
Okay. And so that's what oftentimes made them high net worth individuals. But then what's happening now is they're not being tax managed properly. And so it's a lot of them are paying way too much taxes, because of the decisions they made previously. And so a lot of it comes down to now is, whether it's using the tax management, the tax loss harvesting that we talk about, or a lot of people don't think about too, is, as a joint taxpayer, you might be fine. Okay. But eventually one of the spouses, oftentimes something's going to happen, and we don't know how long that's going to be. And that impact on a single taxpayer, and talking about before, maybe they weren't in an IRMAA and now are in an IRMAA, or or their distributions are pushing them into a higher tax bracket. So we look at it as a lifetime planning, all the way in, whether something happens to one of them or to both of them, they both live to 90, or something happens to one of them at 75 and the other one lives to 95. So it's planning for the all the different ins and outs of that kind of stuff.
Well, and if you think about it the opposite way, what you just said, I love the way you said it. I'm going to look at it from the exact opposite standpoint. When we meet people, generally we are now there may be extenuating circumstances where we meet a younger family or something like that regard, but a lot of times the families we work with are at or near retirement age.
Yeah, exactly right.
But you've spent your life getting to that point. We now have to spend the rest of it working on it and adjusting it. You can't say, hey, I spent 30 years creating this tax problem and we fix it in 30 minutes, right? It's going to take 6 years, 8 years, 10 years, 20 years. It doesn't mean that year one, it can accelerate, it can build. It doesn't mean year one, we don't immediately have savings, right? That's a vital thing. And obviously it's really important. That's why alarms go off when I say this type of stuff. I just heard an alarm that this is a great idea. I don't know if that your phone.
I tell you, I silenced it. I don't know why it's still
That's
doing
because
it.
somebody's calling in going,
I
hey,
think we
I
need
want to
like
learn more
the
about this.
IT
So
guy to kind of fix that for me somehow. Yeah.
somebody said, hey, I want to learn more about this subject matter. So why don't we use that though as a good stopping point to say, hey, let's talk a little bit about our holistic planning happenings, our holistic happenings, because we can go so much further in depth in this subject
Yeah.
matter, and we will probably do additional episodes on this because there's so much to it.
Yeah, I think we maybe in our estate planning we have our next one that we'll do a little bit more about the net worth, because we didn't even touch on the next generation and some of the stuff
Sure.
people can
The
do with the
irrevocable
high net
trust and
worths and exactly,
charitable
the
remainder
charitable
trust.
remainder trust and things
Yeah.
like that. So too. Okay, so why don't you explain how holistic happenings then, John?
So if you're new to this, welcome. If you're not new to this, you've heard this before. The end of every episode, we sit and we talk about a holistic happening. So the idea is something that we came across in our normal business pattern, where is something that's what makes our company unique, what makes our teams unique, is something holistic. Saying, hey, we didn't just talk about one subject matter; it dovetailed and spilled over into other subject matters. And of course, we have that relationship as a company to where we can be able to talk about that or get you to a professional that talks about that subject matter. So usually we use just a kind of example that we came up with in the last couple of weeks since our last recording that came across. So Mike, do you have an example that you came up with?
Yeah, I mean, it's kind of, again, a lot of it's is subject. When we think about what we're going to talk about, John, we prepare for these meetings, it's almost surreal, but maybe because we do this every week that we run into exact scenarios, of the stuff, the subject matters we're talking about. So again, there are a lot of different workshops we do and webinars. You can go to our website, fsa1.com, and sign up for any of these things. They're complimentary as far as that's concerned. But we talk about in our workshops the impact of using the holistic planning. And so again, a lot of the high net worth individuals are good investors, or they may have had a good planner as far as the accumulation phase is concerned. But really, when we're looking at it through the different lenses, so it may be through the investments, through the taxes, through the estate planning. And then when we evaluate the investments themselves, a lot of this comes down to like the risks, the fees, and the taxes too.
Sure.
Okay, and so it never ceases to amaze me. There are people, again, a lot of the middle class millionaires, and even some of the high net worth individuals that we deal with, and they'll come in and they've done a good job. They may not be in jeopardy of running out of money, but something may have intrigued them. And I think I like the way you said it earlier today. It may not be a need anymore. It's more like
More
a
of a
want.
want. Sure.
What can I add value to what I'm doing? Or sometimes it, like the strategies they did a long time ago, and they just need, or they understand that that laws have changed and they need to make some changes. And so I ran into a family recently, and when we were looking at what their portfolio, he was like perfectly happy with what they have, and he's
Sure.
Drawing money out
In their investments and sure.
drawing money out monthly, and he's like, I don't know if I want to change my investments, but I want to. But I do know we need some tax advice.
Okay.
Okay. And so that was kind of the
Starting point.
conversation.
Sure.
And so, again, we do evaluations. And so we evaluate it, through the risk categories, the fees and the taxes. Of course, we do risk assessments and all that stuff, other stuff as well. And again, it's not just this one individual. It's happened numerous times to us. We go in there and realize, okay, he was told he happens to be, I think 68 years old. And he was told, he retired about 4 or 5 years ago from his existing advisor, that, Roth conversions aren't a big deal. You don't need to worry about doing Roth conversions. And so he even told me, the impact for Roth conversions doesn't really make much sense to me. So we did a little category, and we ran some illustrations, and come to find out, based on his tax bracket, even if we went over what we talked about earlier, IRMAA, we could the large chunk of his money was IRA money. He could save themselves hundreds of thousands of dollars in taxes
Matters.
at age 90. Right?
Which matters.
But then what was more impactful, because that was one of the things he was looking for, was some tax advice, but we did evaluate his portfolio as well, and we looked at first versus risk. And of course, it was a little bit more risky than he thought it was. Okay. But the fee structure was probably the biggest thing, because he thought he was paying the 1% management fee, and come to find out most of his portfolio was in mutual funds at about a 0.7%, external or internal expense fee that he was not aware of. Okay. So the issue now is, with this portfolio, so let's just say it's 7/10 and, just a $3 million portfolio, that's another $20,000 a year in fees he's paying. And so let's say over a 10-year period of time, that's, $200,000 plus. That's not even with it growing. Plus, $300,000 or $400,000 in his that he could actually have more net worth for his family during the Roth conversions. So just by doing a little analysis, and again, with all the disclosure,
Sure, sure, sure.
we can't say that's going to happen for sure. We don't know what the market's going to impact, and this is just really an example. But these are just one example that we see. Sometimes it's tens of thousands of dollars, but we're talking hundreds of thousands of dollars of impact on someone that's just borderline,
Yeah,
high
trying to
net
figure. Yeah,
worth, and he thought everything was just perfect and great. And so I don't like to use the word sometimes because I think it's kind of cliche, is that second opinion,
sure, sure.
But if you go to a doctor, you need heart surgery, you're getting that second opinion.
Yeah,
Your finances, this is some of the biggest impact you have in your entire life.
absolutely.
Okay. And so I like to say, instead of having a second opinion, look at it through different lenses.
Yeah.
Okay. And so that's when we do a lot of our stuff, we're looking at it through different lenses. And if you do look at it through that little the different lenses, and there's certain clients that want several things, we can kind of look at things and say, oh my gosh, there are things that we may not even thought of, okay, that can really impact ourselves and for our family, and let alone, you need to think about, we're joint taxpayers now. What's going to be the impact when we're single taxpayers? Because that those numbers can even be a lot higher,
double.
right?
Yeah, absolutely.
So I just thought that was a really good example.
That's a great example. I think it's a great example. Again, it's a component of it's a lot of information when we go through these podcasts. It's a lot of stuff, but you hear things that go, wow, I'm similar to that, or that's something. So that's reasons to reach out, right? So if they want to reach out to us, how do they reach out to us?
You can call our phone number 1-800-977-9292 or our website,
FSA1.com.
Yep. And again, we're doing a lot of these workshops, literally weekly, in many different areas, mostly in the Metro Detroit area, but we have webinars that can be, nationally or internationally for that matter.
Or you can reach us through the podcast. You can give us a call this way.
Obviously.
Absolutely.
Yeah. And you can actually go to our website or call us directly if you want to meet with one of us individually. So that's perfect. All right. Well, this is the Retireable Podcast. I'm Mike Wallace.
I'm John Sauger.
You guys have a wonderful day.
Investment advisory products and services are made available through FSA Advisors, FSAA, a registered investment advisor. Annuity and insurance products are offered through Financial Services of America, Financial Services of America, FSA Health Insurance Agency, doing business as FSA Insurance Agency, FSA Tax and Accounting, and FSA Advisors are commonly owned and operated by FSA Marketing Incorporated. FSAM. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. The insurance products offered by Financial Services of America FSA are not subject to investment advisory requirements. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. FSA. A is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. Chartered Retirement Planning. Counselor and CRPC are trademarks or registered service marks of the College for Financial Planning in the United States and/or other countries. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by FSAA.